Hey guys and girls, so Friday led to some better than expected job figures, but what does this mean for inflation and what does this mean for growth stocks? Let's take a look. So, like I mentioned, if you haven't seen that video, please go and check that video. The non-farm US payrolls led to a beat. So there's a 940,000 new jobs in July, which was much higher than expectations. And this has got people worried about whether we're going to see inflation as wages go up. Now, there was a beat on the non-farm payrolls, which means more people had registered employment. There was a reduction in the unemployment figure and earnings have gone up as well. So this was a triple beat on the non-farm payrolls. And no wonder why a lot of growth stocks, investors, were having a bad day on Friday as people were moving to value and away from growth. But what does this mean a bit longer term? I wanted to spend some time analyzing what Cathie Woods' thoughts are on inflation and her concept of deflation, which he thinks we're going to be seeing. She's got a very contrarian view, which I happen to agree with a lot of the points made here. And I just want to break those down here so we can understand what is that alternative view versus the typical view of we're going to see inflation post this pandemic and post this quantitative easing. Now, let's go back a step. So when the pandemic happened, there was an unprecedented amount of printing of money. And what this is quantitative easing. So in the US, and this is, all the top central banks were doing this, but in the US, the Fed's QE program involved the purchasing of assets, treasury assets, and mortgage-backed securities, MBS, okay, to help bring down rates, okay? So the way this works is they are reducing, the supply of bonds on the market, which increases the price of bonds and reduces the long-term rates, which keeps interest rates low. Okay, they do that to ease the monetary environment, to make things easier in the economy for people during the tough times. Now, we remember from Jerome Powell, and again, I made a video on this, saying when Jerome Powell said, if we see a couple of good months' earnings, non-farm payrolls, we could start the discussion of tapering. Okay, and what does tapering mean? Tapering means that the government will simply start to reduce their purchases. So currently, the US Fed are purchasing 120 billion of these treasuries a month. Okay, so of these treasury assets and mortgage-backed securities, 120 billion a month. Now, tapering would just mean they reduce those payments over a defined period of time, which they'll communicate, hopefully, and they need to bring that back to zero because they can't keep purchasing, perpetually. It needs to come to an end. Now, the only precedence we have is if we look back to the 2008-2009 crisis when the government tapered then, we saw that there was what was called a taper tantrum, which is when the stock market flipped and got upset due to the tapering. Okay, and they were expecting inflation because now if you're not tapering, so suddenly imagine, somebody's been helped so much, the economy's been helped to keep the interest rates down, and suddenly you let go of that support, people are just expecting inflation to skyrocket, and that's kind of the feeling we're getting now. But there's various reasons that Cathie Wood mentions we're not in the same boat this time around, and one of them, she says, we're on firmer footing now compared to 2008, 2009, because there's no European debt crisis, and there's no contagion at the moment, and the market's a bit more stable. So that's our first view right now. Now, the other thing worth noting is those that are pro-tapering on the Fed are suggesting that we don't need to raise rates until at least 2023, because the natural process of tapering and reducing the purchases is going to increase the rates, so we don't need to then manually intervene with extra raising of rates. Now, there's been a lot of mention of inflation in the Q2 earnings. Now, if you listen to any of the Q2 earnings, which I always get a habit of doing for my investments, and I do recommend you guys do that too, you will notice, and the stat actually came up, there's been 1,100% year-on-year growth on the mention of inflation. Okay? Now, Cathie Wood makes a really interesting point and says, well, they're mentioning inflation, but it doesn't mean that that's what's causing them to miss their targets. It could just be that demand is disappointing their expectations. There's weaker demand in the economy, and that's why people are missing their expectations. Because she's saying, look, you knew about supply chain shortages beforehand. You knew about these beforehand when you set your expectations the previous quarter, and therefore it can't suddenly have been a shock that you're blaming the misses on inflation. It could have been that demand disappointed to the weak side. Okay? Now, Cathie Wood then goes on to say, she sees a few key areas for what she calls good deflation. This is a really interesting piece that she talks about. And I do implore you to kind of take a few moments to understand the 3 points she's making here. And the first one is she feels that we're going to get good deflation due to innovation. She's saying that productive growth in innovation reduces learning curves, which can then reduce costs, and that can be passed on as lower costs for consumers. Okay, so in other words, she's saying, hang on, you can look at the good jobs figures, but that doesn't necessarily reflect to inflation because there could be innovation. And that's a very good point here because the old, your typical economic theory will say increased number of jobs, higher wages, more disposable income, people spend more, inflation, right? But what she's saying is, hang on a second. Companies are innovating like your Teslas, like your DNA genome companies, like your AI companies, and they could be they're creating new markets, they're creating more GDP and output, and they could be creating extra resources to hire people without cost push inflation. Okay, just through productivity, innovation, and growth. So they're saying, in fact, it's the opposite, that the deflationary aspect is going to become because of the savings that can be pushed to customers. She used the example of, for every cumulative doubling in the number of whole human genome sequences, healthcare costs can decline by 40%. Okay, so she's saying the advances in the DNA sequencing can lead to the lower health costs, 40%. Every time there's a double in the number of sequences done. She's also saying the same in the advances in battery packs with the likes of Tesla and the other companies in the EV space. She's saying for every cumulative doubling of capacity in battery packs for electric vehicles, costs can drop by 28%. So she's saying we are still in the early days of these cumulative doublings. And so the cost savings can be massive going ahead. Okay. Now, the final example she gives is AI. She's saying she foresees potential deflation from a decline in artificial intelligence training costs. She says she expects a drop to be between 37 and 50%. And she says artificial intelligence is going to permeate every sector, every industry, every company. Very powerful. And we can see how a lot of these advancements in technology are really rifling through the global economy. More so than in the 70s where we did see inflation because of a lack of innovation. Okay, and again, she makes that point. So that was your first one. She's saying that's what we're going to see is we're going to see innovation and therefore not necessarily cost push inflation, but companies are innovating through the growth, okay, whilst delivering reduced costs for customers. And she uses the example of Teslas and electric vehicles and how, these cars are going to become less than $20,000 for a state-of-the-art car. Production's going to increase and it's going to be innovative and the costs are going to reduce to consumers. Now, the second point is she says, and another interesting point, there will be some creative destruction. Okay, now let me explain what this means. So what she's saying is there's a whole bunch, well, she says there's 50% of the S&P at risk by this creative destruction. Okay, she's saying those companies who spent the last 20 years catering to their short-term investors and just delivering instant profits and not actually investing in the long-term vision of where their industry is going, she's saying they are going to suffer. She's saying what's going to happen is they're going to have to immediately pivot. And she uses the phrase scrambling for dear life, okay, just to pivot their businesses to the new world we're in. She uses the example of auto manufacturers and we can see it, right? Whether it's Ford, whether it's VW, whether it's GM, they're all, as she says, scrambling for dear life, trying to get into the EV space. But Tesla knew that 10, 15 years ago and they started that progress, okay, building out where the EV demand was going to be in the future. And so these companies who are now scrambling across, they're going to have two areas of trouble, which builds to what Cathie Woods is saying is creative destruction. One, they're going to have their normal production of, in the case of automakers, they're going to have the normal production of their internal combustion engine vehicles, which she believes are not going to sell once the EV demand picks up. And secondly, if they do create inferior EV products in this case, because she feels like they won't compete with the pure plays such as Tesla, or maybe she didn't say this, but maybe Lucid and these guys who are focused on this industry, then they're going to have to sell this inventory at cheaper prices, thus creating creative, destructive deflation. which is a very interesting point. And she says the two sectors, this is very interesting, the two sectors that have done best this year, and she's right, energy stocks and financials, will see the biggest impact from creative destruction. She's saying in the financial services sector, growth in assets held in digital wallets is moving at a pace faster than anyone could believe. And she's absolutely right. You know, China showed the way with WeChat and the WeChat Pay, and then now Alipay. And we've seen Venmo in the US, Square's Cash App. So everybody's moving to these digital wallets. And we know with crypto what's happening in DeFi and all these platforms. So already these platforms such as Square's Cash App have scaled to a level higher than JP Morgan's customer base already. So this is really going to be a disruption for the energy and the financials. And the word she uses, she says, the digital wallet evolution or revolution has gone viral. So financial services, beware. That's what she says. Okay. So the point there is, just to reiterate, is the creative destruction. It's companies where they've not innovated. They're going to rush to panic to innovate. And she feels they're going to create a bunch of inferior products, which they're going to have to sell at maybe even a loss, but they're going to sell at cheap prices, which leads to deflation. It'll be good for consumers such as you and I, because we're going to get to pick up these cheap electric vehicles, which Ford or GM couldn't sell. That's the idea. And the third and final reason she feels we're going to see deflation as opposed to inflation are cyclical deflation. Now, she's under the impression that she was under the belief system that we've seen a lot of pile up of inventory. She feels due to this unprecedented times, everybody had a reason to stock up. Whether it's individuals in houses or it's businesses, we've seen commodity prices and durable and non-durable goods prices go up. And she feels that people have excess inventory of these durable goods. And so she believes as these quarters play out, we will notice a weakening in demand for these companies because people are no longer having to buy more because they've realized they've already got inventories at home. So she feels the inventory is stuck on the consumer side and the businesses side who are purchasing, as opposed to the corporation side. Now, what she says is, we believe that there's a lot of double and triple ordering taking place right now. I think supply chain management systems are getting better, so maybe it won't be as bad as it has been historically. And she finishes on this point because, look, this is a contrarian view that Cathie Wood has. And I encourage all investors, whether you're new to this game or you've been here for a little while, it's important, as Peter Thiel says as well, to have a contrarian mindset. But I don't think we should get carried away with just forcing ourselves to be contrarian. We have to have a tasty piece of contrarianism, just to help us make sure that we're not just following what the mainstream media is saying, but also not just being a contrarian for the sake of it. And she ends this on saying, if we are wrong, then we will be perhaps uniquely wrong. Even so, the reward can be greater. At these times, if you do take a stand differentiated from the crowd for a good reason and not just to be a contrarian, the payoffs can be enormous. She then says, we do think the bull market has broadened out and we look forward to innovation rejoining the party once again. So there you go. That, in a summary, to summarize, that's what Cathie Wood feels is going to happen. She's seen the job figures. She understands that that means the market are going to start thinking about tapering, which could lead to some inflation. But her counter argument are the three reasons which she feels inflation will not actually come to fruition. And she's not only saying that there's not going to be inflation, she's going completely the other side to say there could be deflation. One, because of the innovation. She feels real innovative companies, and she quotes companies like Zoom and Tesla and Teladoc. She feels these, and then obviously the advancements in DNA technologies and AI. She feels these companies are going to lead to real innovation, which can lead to lower costs for consumers without cost push inflation. Her second point was the creative destruction, with companies out there who are panicking to pivot across to the new world and creating an inferior set of products, which they'll have to then sell to the market at lower cost, thus leading to deflation. And finally, she says her cyclical deflation. She feels there's been double and triple ordering and people are stocked up with commodities, with durable and non-durable goods, and that we will see a decline in these orders going forward. So there you have it, guys. Really interesting. Are you concerned about inflation? Comment below. Let me know what your thoughts are, but it's definitely an interesting environment. I think it's going to be important to see the next job figure for August, as I believe that will give us a good indication of where the Fed's thinking is around tapering and whether they're going to start reducing their purchases of mortgage-backed securities. So there you have it, guys. Hope that was useful, and I'll see you in the next one.